Hey everybody, welcome back to Ryan Makes Sense. Today we're looking at Designer Brands Inc. That is ticker symbol DBI. We've got some advanced charting on Think or Swim to look for long-term supports and resistances. We're also going to run our proprietary stock price projection calculator to see if the stock is worth 560 or maybe it's worth $4, maybe it's worth 8. We're going to figure that out together. And we're also going to see what institutions and hedge funds are doing. Are they loading up or are they getting out as fast as they can? All that and more after we hit the like button today. Today's the like button day. Okay, designer brands. One thing I do want to call out, and other people as well probably know this. Every time they have an earnings call, the stock drastically jumps down but recovers insanely fast. If you recall last earning, I believe mid-ish before mid-September, it dropped as far as $4.36 and then it jumped right back up immediately over $7 and now it has dwindled down now to 560. We saw the same, literally the same type of action the last earnings call early June, even before even that earnings call late March. I don't know how this happened, but the stock opened literally at 8.30, $8.30, and jumped all the way to 11.40 off earnings. But as the trend and historical pattern shows, every earnings call, the stock rebounds very quickly, but then it dwindles down. So that type of price action shows me people see that there's a huge discount, they buy the stock. Slowly over time, I think big money starts to get out because the earnings sucked or was not what they wanted to see. So big money gets out, excited, people on the sideline get in. It's a little bit of a trade-off, but overall, the stock is literally just trending down, and you can see this here. We do like to look at the bigger picture, so we're going to go ahead and look at the bigger picture here. And yeah, we really we kissed this line that I set up right here. Exact, right on the lips, no tongue, no nothing, just a nice peck perfectly. And on my Think or Swim, it's literally the same pattern that I have. You can see the candle for June, nope, September, literally kissed the line there as well. So a lot of kissing on the lines with the stock. Okay, looking at our preferred indicators, my preferred indicators, strength, obviously you can see, I'm just going to enhance it a little bit. You can see it's going down, but it's also going down in a descending triangle, which is typically it can be a bullish stock chart pattern, Japanese candlestick pattern. We're looking at the RSI here, so you can see our support, resistance, 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 and then maybe it comes back up and tests over here. You can see the test. You guys can see it, right? Yeah. Okay, looking at our MACD momentum. Again, it looks like it's with the bears. Looking at our candles, it's obviously with the bears. The end of October is coming next Thursday. Yeah. So I'm recording this on the 27th. This isn't coming out until like mid-November. Money flow, this is obviously going down. However, asterisk mark, this is old data. FinViz does show old data. This site right here that I'm highlighting, this shows new filings and forms from hedge funds, banks, ETFs, etc. So we're going to really see what's going on. And our relative momentum is literally about to breach the bottom of the ocean into like sand and debris. So this is with the bears at the moment as of today. Um, Before we dive a little deeper, this is fantastic. This is great. You can see there is natural and organic share accumulation by retail traders and big money. The shares float or shares outstanding in 2020 was 71 million. As of today, it's 2024, it's 57 million, but as of today, it's 49 million. So about a 22 million share differential from 2022 today, which is good. Sales, this is not looking too pretty. You can see it's like we had about the pre-COVID, the dip. Comeback. Now we're seeing some stagnation here. 2024, we're at 3.07 billion. 2023 was 3.32 billion. Not looking too good. Earnings per share, again, you can see the downfall and then the slow rise up. But now 2024, again, um, not looking too good. And I do just want to call out some beige and red flags that I'm seeing with the stock. You guys probably see it as well. They're not profitable, but barely. Their quick ratio, this is a red flag if I've ever seen one. And they're also offering a dividend. Now, it really baffles me when companies do not have clean or efficient balance sheets. They offer a dividend. Why don't they put this exact money that they're giving the shareholders as a reward? Stop that, put it back into the business, get yourself to a better position. I mean, their debt is just horrible here. They're barely at, I mean, they're addressing it. You can see from 3.59 to 3.13. They're addressing it, but still, if they were taking this money instead of giving it to shareholders, invest in yourself, make your balance sheet stronger, reduce your debt, add to your cash, you know. So that's a red flag right there. Forward PE shows this is very undervalued, which is fine. But if this company's ugly behind the scenes, which it really is, a quick ratio of 0.25 means if they close their doors tomorrow, they can't pay off any debts, loans, margins, etc. They can pay some, but not all of them. So there's that. Earnings per share year over year, negative. Sales year over year, negative. So we're definitely seeing some stagnation with this company. It looks like institutions are really buying the boat. We're going to validate that. Gross margins are extremely good here. Again, if they could just right the ship, enhance, make their sheets more efficient, come on, you know? Again, profit margin barely. They're barely not profitable. This is something they could address. A lot of people are shorting this stock, so just a heads up there. And they're shorting it because it looks like they're becoming less, their sales are lackluster, their earnings per shares are decreasing significantly. They're giving away cash to shareholders when they need to keep it themselves. So this is almost not investable to me, but we're gonna run the numbers here and see exactly what we got going on. Market cap we only include if it's over 1 billion. This is at 300 million, so this is obviously not going to be included. Income is negative 4,950,000. They do 3 billion, 60 million in sales. Good for them. Okay, now we're down to the cash and the debt. Before we jump into the cash and debt, Q1 2024 they did 754 million. They paid 546 million to get that. Q1 last year, they made about 6 million more. They spent about 8 million less, and their gross profit was about 15 million more last year. Let's see their gross margins on that. 29% last year compared to 27% this year. So again, becoming less efficient, spending more to make less. Not good. Q2 2024, they did 746 million. Q2 2023, 742 million. So they made about $4 million more. They spent $3 million less. So that is actually a good sign. So their gross margin should be a little bit better here. Gross margin 32 compared to, no, it's about the same. 32.04 compared to 32.82. A smidge difference. And Q3 2024, 771 million. Q3 2023, 792 million. They spent literally almost the exact same amount. However, Q3 2023, they were about $21 million more gross profitable. So right here, gross profit 34.5, gross profit 32.7. So I'm not saying they're not trying to be more efficient, but literally Q3 2024 versus Q3 2023 goes to show you that their brand is losing their stickiness. There is some weakness in the brands. People are not resonating with the brands. So this is a good testament to, hey, how are our brands doing year over year? The stickiness is down 20 20 million, 21 million. So that's to a $3 billion revenue company, maybe not that much, but looking quarter over quarter, analyzing that, that is a warning flag to the company. So, water break. Okay, back to our calculation here. Cash, they do have 38,830,000. Debt, total debt. So you can see they had 1,126,000,000. Now they have 1,112,000,000. So they paid off about 14,556,000. Not bad. But you can see they are addressing that. Okay, so debt is 1,112,390,000. All right. Now let's just take a peek. Total assets 2.1 billion, total liabilities 1.7 billion. Looking back last quarter, 2.16 to 1.8. So they decreased their liability about 53 million. Assets decreased about 56 million. That's not good, but it seems like they're trying to make things more efficient, really. It really does seem like they're trying to make it more efficient. Wow. So liabilities from Q1 to Q2, right? Q1 to Q2. Liabilities reduced about 123 million. Assets decreased about 124 million. So it seems like they are trying to find their sweet spot in terms of efficiency. I don't think they're there yet, but the paying off of the debt is a step in the right direction. Liability reduction is also good, but it also decreases their assets. But at the same time, you need to get to that sweet spot where you can decrease your liabilities and your assets actually don't match or exceed that. That's when you know you're getting into a really good rhythm. Once you can decrease your liabilities and your assets go up, that's when you've hit the gold mine, the needle in the haystack. So they're almost there. I mean, from Q1 to Q2, they reduced over 120 plus million. Assets decreased about 120 plus million. And then Q2 to Q3, assets decreased 52 million. I'm sorry, liabilities decreased 52 million. Assets decreased about 55 million. So you can see it went from a 100 million decrease in liabilities to a 50 million decrease in liabilities. Are we going to see a 25 million decrease in liabilities? It kind of looks like it's getting cut in half every quarter we see when we look at quarter over quarter or quarter to quarter. So I think this company is getting close, but not quite there yet. Let's go down here and see. Sonnenberg sold uh, 44,000. I don't see any options for Sonnenberg. Well, plus this, so about 53,000 sold. Mark Haley sold 25,000 plus 16,000. So we're seeing, okay, we're seeing, I mean, there's no red flags down here. That's what I'm looking for, is just red flags. Um, Typically we like to see the CEO buying. And when we see the CEO buying, that signals that the stock is undervalued. When we see CEO selling, it's stock is overvalued. We can see the CEO is getting stock options, which is fine. There's no buying or selling by the CEO. So I'm not too concerned, honestly. There's no real beige flags down there. My only biggest issue is that they're giving money to shareholders when they need to put that money for themselves. I promise you, shareholders will see that, and this will be a benefit to the company. Yes, there's going to be a PR shock. Oh, DBI is cutting their dividend, but they're doing it to strengthen their business. That would be a huge power move. Maybe it would jolt the stock down, but at the same time, the stock would be reversing way faster than it is now. So, back to our calculation here. I'm done ranting. So I do also just want to call out this calculation here does not account for the money that the company is giving away. We can see that they have cash here and their revenues. We do not account for money that the company is giving away. So this price target is going to be really high compared to the stock or compared to what we're seeing. So don't be shocked here when we see a high number. There's 49,490,000 shares outstanding with a potential stock price of $40.04, signifying that this is extremely undervalued. Analysts have a price target of 575. Um, I mean, the stock has been at 40 before, so I can see it happening. And I do really see it happening. Um, I know there are Wall Street quants and mathematicians who use a similar calculation. So if this stock is as undervalued as I'm saying, so my calculation says $40, actual stock price is 560, we would see institutional and hedge fund ownership above 103%. So old data says 103%. I'm going to say it's a lot higher. Do you see that? 123%. Okay, we can see here it looks like there was a little dippage. 123%. BlackRock added earlier this month 3 million shares. DE Shaw added 2.4. Stonehouse added 3 million. Vanguard sold 13% in February of this year. BlackRock sold 14%, but it looks like they added 3.5 million on top. It's weird because it's not showing if they added 3.5 million more or what? Because we see BlackRock and BlackRock. And then Millennium Management sold 95%. So institutions and hedge funds are indeed adding. 103% is old data and 123% is new data. So that is pretty huge. Looking at our patterns here, we can see we've had these purple channels. If the company was going to turn their boat around, this would have been the earnings to do it. You can see the stock tried to hold on and keep this. It failed. So now we are in this area here where we should expect to see around $4.50 again in the next couple of months. The next earnings call looks like it is December 3rd, potentially. That is an estimated date on Thinkorswim. I think once we exit this apex right here, where we have our long-term support versus our long-term resistance, I think this company really figures out their sweet spot. If they don't go bust, honestly, if they don't go bust, but I don't think we're going to see them get to bust because, I mean, they're almost profitable and they need to get rid of this dividend and put it towards their business yesterday. So pay off that debt, add some more cash, get into a healthier position. Like you got a lot of people thinking you're going to fail here. 11 million of the 49 million shares available, over 25% think this company is going to fail. I'm not saying it's going to fail. It is going to get through some hard times here. Um, and let's see, our Q4 is typically strong for this company. Let's see. Q4, yeah, Q4s are actually pretty strong. 865 million, 786. Oof. But looking at the Q4s, they're getting hit pretty hard. If this trend continues, 865 million in 2022, 786 million in 2023. Gosh, that's a $180 million, or I'm sorry, $80 million difference. That would mean Q4 2024, we're going to see around 700 million, which is going to be a stab in the heart if that trend continues. So again, get rid of this dividend, put it towards the company, get your quick ratio up, get your debt down, get your assets up, get your liabilities down, and this thing is beautiful. Yeah, that's my 2 cents. In terms of price targets on the downside and upside, so the upside, well, the downside we'll see about 458, probably maybe going below 430. In terms of spikes up, we could see, I mean, it's been a while. Let's see. tested this about once, twice. I mean, I would say maybe mid sevens, 20 mid 2025. But look at this breakdown right here. We can obviously see we can obviously see this has fallen. So 450s, here we come. And then again, 626 will be our first target, and then maybe mid sevens in mid 2025. But this thing does need a crash course because it does really need to reset, unfortunately. Um, and they need to get rid of that dividend. I can't stress that enough, unfortunately. So if you made it this far, thank you so much for watching. Consider subscribing. Let me know if you guys think I'm crazy and if none of this makes sense. Take care. See you soon. Bye.